apart from having a plethora of indirect taxes, the current tax structure has another major problem. In fact, a bigger problem. That is, when you buy something, you're in effect paying tax on tax. This is called the cascading effect. The best way to clearly understand cascading effect is to look at a numerical problem. But before going into a numerical problem, we'll touch base on certain concepts like the input credit. More often than not, manufacturers, sellers cannot claim input credit under the current tax structure. What is exactly input credit? It is basically the tax that is paid by manufacturers or sellers on their purchases. And this tax already paid by them cannot be claimed or reduced from their output tax, that is the tax that they'll have to pay on their sales. This is input credit. Taxes paid on purchases can be reduced from taxes payable on sales. If this is the case, then you are set to have input credit. If not, then you cannot claim input credit. That is, you cannot set off your output tax liability. Time to move into our example. Let's take the case of manufacturing a shirt. First, let's look at the processes involved because tax is levied at each and every stage in the entire production process, right from manufacturing to distributing to final sales. We can now move on to our numerical example. For that, let's draw up a table. The first column would be the action as to what are the people involved in this process of production doing. Second is the cost, that is what is the cost for doing that process. Third is tax, and the fourth column is the total of cost and tax. There are two assumptions that we've made, that the tax rate does not change throughout the process. It is at 10%. And that none of these people have included any profit. So everything is at cost. This is just to simplify the example so that we can understand better. It does not make a difference if the tax rate changes or the profit is added. It just changes the calculation. That's it. So these two assumptions are just to simplify the process. So now let's move to the first stage in our production process. The manufacturer will buy raw material. The cost of raw material is 100. He will also have to pay a tax at 10% on this raw material. So the tax on cost of 100 would be 10. The total cost that the manufacturer will have to bear for his raw material would be 100 plus 10, 110. This raw material moves into the next process, that is of manufacturing the shirt. It is assumed that in the manufacturing process, an additional cost of 40 is incurred. So after the shirt is manufactured, the cost would be 100 plus 10 of raw material plus 40 manufacturing cost, that is 150. Adding a tax at the rate of 10% of 150, that is 15, the total cost of shirt after manufacturing comes to 165. The next process, wholesale. Again, the value added is 30. Same as we did for manufacturing, the cost would be 165 plus 30, 195. Add tax of 19.5, cost would be 214.5. Last stage is the retail, that is the final sales stage. A value of 20 is added, so the cost would be 234.5. Add to that 10% tax and the final cost of the shirt is 257.95. Notice that the cost without any tax is 100 plus 40 plus 30 plus 20, that's just 190. To this, a tax of 67.95 is added. Let's try and understand the taxes better. Now, when the manufacturer buys raw material, the tax he's paying is VAT. In the second stage, after manufacturing, the tax is excise. Third stage, when he sells it to the wholesaler is paying a VAT and the retailer is paying GST. Now that our example is set, we are going to understand what cascading effect really is. Notice in the manufacturing stage, tax of 15 is paid. This 15 is on a cost of 150. Now this 150 includes 10 tax of the earlier stage. This is what is meant by tax on tax. In the next stage, the tax of 19.5 also includes tax on 10 and 15 of the previous stage, and the same is the case with the last final consumption stage. And this is the concept of tax paid on tax. Why did this happen? This is because input credit cannot be claimed in any of these stages. Let's understand that VAT, excise, VAT and CST were the taxes paid. VAT is a state tax, whereas excise and CST are both central taxes. As per the input credit rules, central taxes and state taxes cannot be claimed against each other because you're paying central tax to the central government and state tax to the state government. So you cannot set off these two tax expenses. Let's look at CST in particular. CST credit is not allowed at all. That is, if you've filed all C forms and everything is in place, CST input credit is absolutely not allowed. Another restriction on input credit is that the state tax of VAT cannot be claimed against any other state taxes like luxury tax or entertainment tax. So VAT can be set off only against VAT and not against any other state taxes. These are the restrictions on claiming input tax credit. There are many more restrictions. These are just the examples which match our numerical problem. And that's why none of these taxes can be set off against each other, and our total tax liability is $67. This is a major limitation on input credit.